Hello again, hi, it's Gina here from Will Written, helping you to put your affairs in order and plan a secure future with the magic of estate planning. This video goes with my earlier one, offering advice and support to anybody who's got a buy-to-let portfolio. I promised you in that video that I would give you some separate hints and tips about inheritance tax, because for buy-to-let investors, inheritance tax is a whole can of worms of its own. And the reason for that really is because to build up a portfolio that is deriving enough income to meet your aims, you have to have so much capital behind you in land and buildings that are exposed to inheritance tax that it's really easy to get into the realms of inheritance tax liabilities quite quickly after your first couple of properties maximum, really, you know. And that's because the allowances available are quite small, really. Every individual has an inheritance tax allowance of £325,000, which means that married couples have got between them £650,000 of inheritance tax allowances. And that's really what's available for you to shield your buy-to-let portfolio in. There's a separate inheritance tax allowance available for the family home and passing that down to the next generation. That's £350,000, but that can't be brought across to other properties that you might own, such as your buy-to-lets. So you've only really got £650,000 maximum to play with, and that's only if you're a couple. So you really do need to think quite hard and start quite quickly and take action as soon as you can during your lifetime to reduce that liability or make it go away, but certainly manage it as far as you can. And there are quite a few things that you can be doing if you play your cards right, basically. Today I'm going to share with you 7 suggestions that you might want to think about. Now, the first of those suggestions really is simple giving. The basic principle is if you just sign over one or more of your properties over to your kids, then 7 years later, it's left your estate for inheritance tax purposes, and so it won't count, that property won't count towards your inheritance tax bill. So that's why a lot of people look at signing their properties over to their children by way of succession during their lifetime. The downside of that, though, unfortunately, is that that act of signing over a property, although money doesn't change hands, it still actually is a chargeable event for capital gains tax. So you might find yourself facing quite a significant capital gains tax liability. Also, if the property's mortgaged and your child is taking over the mortgage as part of the handing over of the property, well, that for tax purposes is regarded as your child making part payment, and that in turn triggers stamp duty. So there are 2 major downsides to that act of simple giving where properties are concerned. A second suggestion is to consider creating a trust fund and transferring properties into that trust fund for your children. The advantage of that is that you can avoid capital gains tax or indefinitely delay capital gains tax by doing that, because if you transfer a property into a trust fund for the benefit of your children, then you can claim holdover relief against capital gains tax, and that means that any capital gains tax doesn't have to be paid until such time as the trust itself sells the property, which may never happen actually, you know, although obviously the gain goes right back to when you first acquired the property. Now, there are downsides to that, however. Creating a trust fund is something that's only really available in respect of properties that are not mortgaged, because generally mortgage companies just don't like lending to trustees. I'm not sure of the reasons for that, but there probably are good reasons. The other downside is that you're very limited as to the amount of property that you can transfer at any one time into a trust fund without incurring some quite complicated ongoing lifetime inheritance tax liabilities that I won't bore you with right now. But basically, you can, as an individual, transfer up to £325,000 worth of property into a trust fund during your lifetime every 7 years. And as a couple, you can obviously, between you, transfer 650. Now, that might be enough, a couple of multiples of 7 years, and you might have transferred all of your properties into the trust fund, or all of your surplus properties into the trust fund for the benefit of your children. So you might avoid those problems. The only other real thing to be thinking about is that you can only legitimately create a trust fund that is specifically for your kids. By that I mean you can't retain any kind of benefit or ownership to the properties that are within the trust. So for example, you can't retain any of the rental income for yourself. You have to be prepared to completely relinquish all claim to the property and its value and the income that comes from it. So obviously that could end up leaving you short. So you need to think very, very carefully about whether creating a trust fund is the right option for you. The third option that you can consider, and you need to talk to both your accountant and your financial advisor for this, is if your portfolio it contains commercial property, well, there is potential for that commercial property to be owned by a self-invested personal pension, a SIPP. So if you do that, then you're taking the commercial property itself outside the realms of inheritance tax altogether, and you're using your pension lifetime allowance for this. So every individual has got £1 million lifetime allowance for pension. So a couple could potentially hold between them £2 million worth of commercial property within a SIPP without any tax problems coming up. And of course, that would take it outside the realms of inheritance tax. It's a complicated area. Don't think about it on your own. Definitely talk to a well-qualified chartered financial planner about it, but it might be something that's worth doing if you're a landlord of shops and offices and that kind of thing. Another thing to seriously consider is to turn your portfolio of properties into a limited company. So now that's going to involve transferring your properties from your names, your personal names, into the name of your company. Now that again attracts capital gains tax, so you need to be careful about how you go about it, although there is such a thing called incorporation relief that you might be able to talk to your accountant about. The thing about owning your portfolio as a company is that you can split your company up into as many shares as you like, hundreds and hundreds if necessary, and then you can be transferring small tranches of shares across to your children during your lifetime annually to keep the capital gains tax right down. You don't have that option where you personally own properties, because you can only really practically transfer an entire property at a time, and therefore obviously take the entire hit as far as capital gains tax is concerned. So incorporation can be really helpful in terms of controlling the rate at which property is transferred from your estate for inheritance tax and succession purposes. Now, if you do have an incorporated portfolio, that brings us to the fifth sort of idea, which is potentially that you can use certain commercial arrangements with your kids to basically have your cake and eat it, whereby you can transfer ownership of the property to your kids, well, the property, the shares, if it's shares, if it's an incorporated portfolio, while still retaining some income. And the way you do it is this: you would either give the properties entirely, or the shares in the property company, to your children entirely, but become a PAYE employee of the company, and then you take the income that you need as PAYE salary, basically. Downside of that, of course, is that you're going to have to pay income tax and national insurance and employer's contribution national insurance, but it's worth considering, worth talking to your accountant about, and just thrashing out the pros and cons. Another way of doing it is to actually sell your shares in the property company to your children at full market value, but take payment by way of monthly instalments equivalent to the income that you need to retain for yourself. Now the thing about that then is that your monthly income is actually effectively loan repayments rather than salary, so it can be a very tax efficient thing, certainly from an income tax point of view. Again, these are suggestions that are just basic principles that you must talk to your accountant and or your financial advisor about, really. Another really, really useful thing that's very popular, suggestion number 6, is to use life insurance. This is really only something that is practicable if you're relatively young and you're in good health. But you can take out a life insurance policy whose proceeds are equivalent in value to your projected inheritance tax liability. The thing to do about that then is that you have the policy written in trust in favour of the executors of your will, so that it pays out to your executors in the event of your death for the specific purpose of discharging your inheritance tax liability. Like I say, though, it's only really affordable if you're quite young and if you're quite fit. The older and poorlier and chubbier and whatever you get, the more expensive and the less affordable the monthly premiums are going to be for that kind of insurance. Another thing, number 7, this is a bit off the wall, but I think it's becoming more and more popular these days, is to cash in some or all of your portfolio. Sell your properties, but then roll over the proceeds straight away into an enterprise investment scheme or a venture capital trust. Again, this is a very, very kind of esoteric bit of financial investing, and you need to talk to a chartered financial planner about it. But the tax advantages of enterprise investment schemes and venture capital trusts is that they are exempt from inheritance tax after 2 years, because you can claim business property relief. You can also claim that holder relief against capital gains tax, and in certain circumstances you can also claim a certain amount of income tax relief. So there are advantages and incentives for investing. The downside, though, is that these types of investments do tend towards the riskier and more volatile end of the scale. So you would only approach it with great caution, with the support of your financial advisor and probably your accountant, and you wouldn't be putting all your eggs in one basket. Maybe part of your portfolio you could consider risking on that. So those are the 7 kind of ideas that you can explore. What you really need to do is take some proper advice on your circumstances, talk to your financial advisor, talk to your accountant, but then of course you may want some proper estate planning advice from me, in which case by all means give me a call. I'm going to leave the number below, or visit the website. There's a blog with a lot more advice on this kind of issue for you to explore further. So I hope all that was helpful, and I'll look forward to talking to you again in my next video. Bye bye.